In this video, let's talk about how you can live off dividend income in 3 simple steps. What? Now notice how I said simple but not easy. Because to live off dividend income requires diligence and also discipline over the long term. But the reward is a truly passive income stream that will cover all your expenses so you can pursue whatever passion that you want. What is up everyone, it's David here. Now make sure you watch this video all the way to the end, because at the very end, I was sharing a mini hack that will fast track your ability to live off dividend income. Now, if this is your first time here, remember to subscribe, click onto the bell, and always gently destroy that like button. Without further ado, let's go. Now, before we jump into the 3 simple steps on how you can live off dividend income, it's important we talk about, is it even possible to live off dividend income alone? In order to live off dividend income, your investment portfolio will need to generate enough cash flow to cover all your expenses. According to home loan experts, it costs approximately $26,000 to live in Australia as a single person renting in Sydney. For your investment portfolio to yield $26,000 at a dividend yield of 5%, you're gonna need approximately $523,000. Now, for all of the calculations, I'm not including taxes. In a later example, I'll talk about a more practical example. I just wanted to do a simple calculation to demonstrate my point. Now, the cost of living will be very different in other countries, but is it possible to live off dividend income? Yes. But would it happen overnight? No, absolutely not. The important point that I'm trying to make here is that yes, although it is possible to live off dividend income, it really is a marathon. And this marathon, I wouldn't take lightly, because it requires you to be disciplined and diligent over the long term so that you can earn more, save more, and invest more. So now that we've established that yes, it is possible to use dividends to cover all your living expenses, the first step to how to live off dividend income is determining your living expenses, then calculate how much you need in your investment portfolio to cover all of that expenses. Now, I'll use my own personal example here. Currently costs me approximately $1,500 to live in Sydney, Australia, which means it's approximately $18,000 per year. Granted that it's gonna take me some time to build up this portfolio to generate enough income to cover all my expenses. That means for my portfolio to cover all my living expenses, I'm gonna be much older then, hopefully not in the 40s, but in my 30s. So in my 30s, instead of spending $18,000, I'm looking to spend $30,000 because I'll be very comfortable at that point. So the thing to remember here is that $30,000 is take-home pay. You want to spend $30,000 after tax. So then we have to determine what is that amount pre-tax. So let's look on the screen right now. Now, the taxation system for different countries, it is different, so you have to do your own calculations. But in Australia, in order to take home $30,000, I'll need to have a pre-tax income of approximately $34,000. As you can see here, that the first $18,200 is absolutely tax-free in Australia, and then every dollar after that is 19 cents, which means my tax payable is approximately $3,000, and in order for me to take home $30,000, I'll need to generate $34,000. Okay, back to me. So in order to generate $34,000, assuming the dividend yield is 5%, you want to do $34,000 divided by 0.05, which will give you approximately $680,000 to generate enough income to cover all my expenses. Obviously, I'm ignoring inflation, dividend growth rate, and share price growth as well. But for simplicity's sake, that's how you approximate how much you need in your investment portfolio to generate enough income to cover all your expenses. Now that we know approximately how much we need in our investment portfolio and a target dividend yield of 5%, this brings us to step number 2, which is building a dividend income portfolio. Now, there are 2 main routes when it comes to building your dividend income portfolio. And I'm not gonna go into a full dividend investing strategy here, but I'll focus on the guiding principles of the 2 routes. Now, the first route is picking individual stocks that will generate a steady stream of cash. Now, when it comes to picking individual stocks, what you want to remember is that you want that company to be able to pay out dividends consistently greater than 5 years, 10 years if possible. Because a consistent track record of paying dividends is essentially a commitment to shareholders that, hey, if you guys invest in us, this is what you'll get. Of course, if they can dish out dividends consistently over 5 years, 10 years, or even 15 years, it means that their management team are able to navigate turbulent environments and still able to give dividends to their shareholders, which is a very promising trait of an individual stock, because you can only pay out dividends using cash. Now, the second guiding principle when it comes to picking out individual stocks is whether they are consistently profitable. Now, because dividends are paid out of cash, if you're not consistently profitable, it's highly unlikely that they can continue paying dividends in the future. And guiding principle number 3 is that you want to look for companies who have earning growth potential of anywhere between 5% to 10%. Now, one of the ways to check their earnings growth is read their historical earnings report. Now, historical performance doesn't mean that they're going to keep growing into the future, which requires some kind of knowledge in that industry. So if you like an industry, make sure you do more research in it and see if the company is doing things that will help its growth in that industry. The fourth guiding principle when it comes to picking individual stocks is checking whether the company have too much debt. Now that sounds a little confusing, so let's go into my screen right now. Now, as you can see on the screen here, I use CSL as an example. CSL is essentially a biotechnology company that develops products that help treat or prevent serious human medical conditions. So I took a screenshot of their 2018-2019 annual report, and where I got the screenshot is from their balance sheet. So if you're just evaluating a company, just search for balance sheet and go all the way to the bottom. You should see a table where it says total liabilities, net assets, equity, and total equity. Now, total liabilities consist of both current liabilities and non-current liabilities. Current liabilities are essentially debt that has to be paid within 12 months, and non-current liabilities means that it'll have to be paid greater than 12 months. And total equity, the easiest way to understand that is total equity equals all of the company's assets minus its liabilities. How much is there left over? As you can see in an example here, CSL has approximately $7 billion of liabilities and have $5 billion worth of equity. Now, it's normal for a company to have a little bit more liabilities than its equity because they're borrowing money to grow the company's operations. What you want to really pay attention to here is the debt to equity ratio. So if we have $7 billion worth of debt and we have $5 billion worth of equity, the ratio is approximately 1.4, which means that for every $1.4 of debt, there is $1 of equity. Obviously, when the ratio gets higher and higher, it's more dangerous for the company because they're taking on a lot more risk. And usually for dividend income companies, you want them to be stable and not over leveraged. In our example, I'm obviously approximating here, 1.4 is absolutely okay. When we start heading into the 2 territory, where for every $2 there is just $1 worth of equity, it gets pretty dangerous. So for me personally, I try and stay below 2 if possible. And the last guiding principle when it comes to picking individual stocks is that you want to diversify your portfolio as much as you can. You should never depend on just one company dishing out dividend income because you never know what's going to happen in the future. Now, the second route when it comes to building your dividend income portfolio is ETFs. Now, these ETFs most of the time are essentially handpicked most stable companies that dish out dividends consistently. The guiding principles for ETFs is actually pretty straightforward. You want management fees to be as low as possible, and personally I would recommend management fees below 0.5% if possible. The second guiding principle when it comes to choosing ETFs is that you want a track record of distributing dividends. So very similarly to picking individual stocks, you want those ETFs to be able to consistently pay out dividends no matter the times are good or the times are bad. And one of the last guiding principles when it comes to choosing ETFs is you want to avoid abnormally high dividend yield ETFs. So abnormally high is essentially greater than 8%. Now, if you want to know why a high dividend yield is not necessarily a good thing, I actually did a video on just that, and I'll put a link right here. Feel free to check it out before you come back and finish watching this one. Now, there's actually an additional route that you can go when it comes to building a dividend income portfolio, and that's listed investment companies. Now, if you want me to talk more about listed investment companies, give me a thumbs up in the comments below, and if there's enough people that want to know more about listed investment companies, I'll do a full video on that. One of the final points when it comes to building your dividend income portfolio, especially for Australians, is that you want to pay attention to what percentage of the dividends are franked. For the Australians out there, we're one of the lucky few in the world where companies can choose to pass on tax credits to us since they already pay tax on that dividend income, so that ultimately the government doesn't double tax the same income. Now that we know exactly how much we need in our investment portfolio and how to build a dividend income portfolio, the final step to how to live off dividend income is creating a plan for yourself. By plan, I mean how much do you have in your portfolio right now? How long do you want to invest more? How long do you want to give yourself until you want to completely live off dividend income? And how much do you need to invest per month to be on track to live off dividend income completely? Let me go back to my example. If I want to spend $30,000, it means that I need $34,000 pre-tax. And assuming that my portfolio yields dividends at approximately 5%, then it means that I need $680,000 in my investment portfolio. So if I currently have $50,000 in my portfolio right now, it means that I need to invest another $630,000 to be able to generate enough income to cover all my expenses. So if I break that $630,000 into smaller digestible goals, it it means that I need to invest approximately $78,000 per year, which is approximately $6,500 per month for me to be able to completely live off dividend income by age 35. And of course, I'm not really taking into account share growth, dividend income growth at all. Just wanted to have a simple calculation to demonstrate my point. So I'm currently working on a free spreadsheet that will take into account your portfolio, your share price growth, your dividend income growth, and inflation rates, and a few of the other things to determine a more accurate full investing plan if you want to live off dividend income. If you're interested, make sure you sign up to my newsletter in the description box below. I'll be sharing the prototype with a few users to get some feedback in the next couple of weeks. You'll be the first one to know when I'm sharing the prototypes if you sign up to my weekly newsletter. Thank you for watching this video all the way to the end. Now, I remember that I promised you a mini hack to fast track your progress to live off dividend income eventually. So here's the hack. Always reinvest all of your dividends. Now, the reason why you want to do that is twofold. The first reason is compound interest. Now, granted, it's going to take a bit of time for you to build up that portfolio, enough income to cover all your expenses. Imagine giving more fuel to compound interest to grow on an exponential rate. Now, I'm not saying this is going to happen overnight, but it will happen faster if you can reinvest all of your dividends. Now, if you really need the cash and you're more of a sophisticated investor, you know what you're doing, and you can put that money to a better use, hey, go for it. Do you? Now, the second reason why you want to do that is when you opt into a dividend reinvestment plan, the cash that's reserved for you as dividend income is used to purchase more shares at a discount to give to you. Now, the reason why the shares are at discount is because it's actually cheaper for the company to pay you in shares instead of cash, because that cash could be used to grow its operations faster and bigger. So I want to end this video on this note. Yes, it is definitely possible to cover all your living expenses and live off dividend income completely. But I want to re-emphasize that is a marathon, not a sprint. And I would not take that marathon lightly because it requires a lot of discipline and diligence in continuously earning more, saving more, invest more, so that at some point in the future, you build a portfolio big enough to generate income that will cover all your expenses. Now, as usual, you can support me by subscribing to my channel, clicking onto the bell, and gently destroying that like button, because that will give the YouTube algorithm the secret sauce to share this video with more people out there. Until next time, thank you again so much for watching this video all the way to the end. It does mean a lot to me. See you soon.